Price is what you pay, and value is what you get. It's one of the most famous cones in investing. It's attributed to Warren Buffett, and I've already used it on these videos at least twice. It's also, like a lot of sayings, one of those things where it says a lot and very little at the same time. On the one hand, it is important to remember that what you pay for something, especially a stock, does not mean what it's worth or what it will be worth. At the same time, price is a mere fact. It is what you paid, what you are paying, whereas value is an opinion, and we know how much opinions are worth. In this video, I want to walk us through how we measure price, how we decide what a company's current valuation, what its worth is based on the market price. And then in my next video, we'll work on constructing a well-supported opinion for what its value should be. Share price is the most available measurement of a company's price. But if you remember from our video of what to know about stocks before you start buying stocks, share price doesn't tell us enough on its own. We need at least one other bit of information. The most useful bit of information is number of shares outstanding in the company. This means how many shares are there out there in the stock market for investors to buy. You take that number, you multiply it by the share price, and you get a market capitalization. The market capitalization is basically the market's estimate currently and always changing of what the company's stock is worth. So if we take General Mills and we use closing price from July 3rd of $77.12, and we multiply it by its shares outstanding, which we're rounding to 585 million shares. We multiply those two numbers and we get $45.1 billion in market capitalization. That is how much the market at that price is saying that General Mills is worth. That's the price. Another pricing metric we can use is enterprise value. That factors in the company's debt. This basically tells you how much money would you need to take off the company, take it off the market, take it over completely, to take care of its debt, to take care of everything. How much money would you need at the current price? Which isn't realistic. A company would ask you for more, but just as a concept. So we take that same $45.1 billion of market cap, and now we have to factor in debt or cash. If it has more debt on its balance sheet, we have to add that in. If it has more cash, we have to subtract it. In General Mills' case, it has $11.1 billion in net debt. Add that to $45.1 billion, and we have a $56.2 billion enterprise company. That's its enterprise value, including everything. Again, if a company has more cash than debt, we're actually going to subtract that from the enterprise value. Alphabet, Google's parent, has a market capitalization, again as of July 3rd, of $1.53 trillion. It has an enterprise value of $1.43 trillion. Said another way, it has $100 billion more dollars of cash on its balance sheet than it does of debt. Share price, market cap, and enterprise value will be the numerator for most valuation metrics that we're going to use in one form or another. Which one do we use then? It depends, of course. If you're dividing by something that is a per share number, like earnings per share, you're probably going to use the share price. Otherwise, it depends on the type of company and the type of metric. A financial company, for example, doesn't make sense to use enterprise value for. Generally, if we're taking a number that is before we factor in interest costs, we want to use enterprise value. And if we're taking something that is after we factor interest costs, we want to use market capitalization. That said, I like to account for a company's balance sheet and how much debt it has in almost all occasions. So I tend to use enterprise value more frequently than is technically correct. but we'll get into that later, just so you know where these things fit with one another. The current valuation of a company, how much the market thinks that company is worth, is based on the price of the shares or the price of the company as compared to how much money the company is making. We can package that into all sorts of different metrics and equations, but I'm going to stick to the three simplest. The most common valuation ratio is price to earnings. It's a simple equation. Take the share price, divide it by the earnings per share, and you get a multiple, how much we're paying for those earnings. Let's take General Mills. Using its July 3rd closing price of $77.12 and its 2023 fiscal year earnings of $4.31 per share, we can divide 77.12 by 4.31 and get a price to earnings multiple of 17.9, meaning for each dollar of earnings, we're paying $17.90. We just used their earnings for the last 12 months, for the last year. That's called a trailing multiple. You'll see it with TTM for trailing 12 months or LTM for last 12 months. We could also use a forward multiple. We want to see where earnings are going. The forward multiple is less solid because it's based on expectations, either the company's guidance for what they expect to make, or more commonly, analyst estimates for what the company will make. But it is forward looking, which is useful. In General Mills' case, analysts are expecting $4.5 per share of earnings. We take the same 77.12 divided by 4.5, and we get a forward multiple of 17.1. Not so dissimilar from price to earnings is price to free cash flow. I've said it already, but I like free cash flow as a profitability metric because it's the money that's left over after the company has invested in itself. Usually companies do not report this on a per share basis. So instead of trying to divide and get the per share number, it makes more sense to just use the market capitalization and divide it by the free cash flow raw number. In the case of GM, $45.1 billion market capitalization divided by about $2.1 billion in free cash flow gets us a free cash flow multiple of 21.6. That is their price to free cash flow multiple, even though we use market cap as the actual denominator. The last common metric I'll share for now is if we go all the way to the top line and get a price to sales or enterprise value to sales metric. This is most useful for younger companies that are not yet profitable but are growing fast. We want to put their growth and their price into context, and so price to sales or enterprise value to sales will allow us to do that. While General Mills is not the sort of company that we would value on price to sales because it's profitable and because it's slower growing, we can still use it. If we use the enterprise value rather than the price, so enterprise value of $56.2 billion, we divide that by $20.1 billion in sales, and we get an enterprise value of 2.8 times sales. So 2.8 times enterprise sales multiple. All of these are worth knowing. Each of them have their place, but I want us to focus on price to earnings for now as it is the simplest. It's based on a company's profits, and because there are a couple more things we can use it for in this video to explain the context. What does it mean that General Mills has a PE multiple of between 17 and 18? Is that cheap? Is that expensive? We can't say with any golden rule, but we can start to compare it to other things. First, we compare it to other companies in its industry, to its peers. Let's pull up a table of a few of its peers: Kellogg, Hershey's, Kraft Heinz. If we look at this table, we can see that General Mills is not wildly out of line with its peers. Its trailing multiple is the lowest of anybody's, but its forward multiple is third highest. It's somewhere in the pack. There's not a clear outlier. If there's an outlier in this list, it's Hershey's, and that would be worth investigating. Does it not fit with this group, or is it doing something that deserves a higher multiple, or is it overvalued? You can also compare a company's PE to the S&P 500 PE multiple to get a sense of whether it's cheaper than the market as a whole. Again, the S&P 500 stands in for the market as a whole. The tricky thing with this is it's hard to find what is the multiple because it's based on all the estimates for different companies in the S&P 500, or it's based on an overall number for the S&P 500. There's some math to get the right percentages and so on. But you can Google this and try to find what an S&P 500 multiple is. There are sources out there. I came across Wall Street Journal's page for this, where they had a trailing multiple of 19.6 for the S&P 500 and a forward multiple of 19.8, which is interesting because it implies that the analysts they're using expect S&P 500 earnings to decline in the next 12 months based on compared to the prior year. In any case, every multiple I find is higher than General Mills' multiple, which isn't surprising. General Mills, as a slower growing company, you would expect that its multiple will be less than the market multiple. One other way to put this in context is to look at the company's growth rate using the price to earnings growth ratio, the PEG. This was a favorite of Peter Lynch, for example. He used to say that at Fidelity, they would actually use this to see if a company was worth buying, and they would really look for companies with a PEG of 1. So if it had a price to earnings multiple of 15, and it should be growing its earnings 15% per year. Stocks have gotten more expensive in the 3 decades since Lynch was writing his books, so we can assume that that number is higher than it used to be for what a good buy is, but that's the way he thought about it. It's a sign that a company is growing. So if we go to General Mills, 17.9 is its PE multiple. Analyst expectations for the next 3 years would give General Mills an earnings growth rate of 5.3%. 17.9 divided by 5.3 gets us a PEG of 3.4. The last thing we can look at to really put this into context is what multiple does General Mills usually trade at? You can calculate this by hand, going to its share price when it releases its annual report each year and compare it to the earnings that it had in that prior year. That's a little tedious. Instead, you're more likely to find this on a site like a Seeking Alpha, probably a Yahoo Finance, where they can pull a chart of a company's price to earnings. If we pull up a chart from Seeking Alpha, we can see that General Mills' price to earnings is, over the last 10 years, it's on the lower end, but it looks more or less in line with where it's been about the last 5 years. So not wildly out of line. It would be hard to make an argument that General Mills just needs to return to a higher multiple or to a lower multiple. We can now say whether General Mills is cheap compared to its peers, not so much, or cheap compared to the market, yeah, somewhat, or cheap compared to its past earnings multiples, again, maybe a little bit, or cheap compared to its growth rate, not really. None of that tells us whether General Mills is worth buying. First, let me give a simple illustration. We can see that Alphabet, Google's parent, has a much higher price to earnings ratio in both a trailing and a forward basis. We can also see it has a much lower price to earnings growth ratio, and we can assume from all of this that it is growing much faster than General Mills, which is where we can start to think about why would there be a higher multiple on Alphabet's earnings? Everybody can see these numbers, but investing is not just a numbers game. We can think that Alphabet as a tech company has more room for growth, or Google as one of the best businesses in the world is less likely to have to cut margins than a business like General Mills, or that Alphabet has higher margins anyways, and it has more opportunity to expand into new fields. That's where we can go back to that $100 billion of excess cash it has on its balance sheet. It could buy 1 or 2 General Mills if it wanted to get into the food industry like that. It would probably be a bad sign if it did, but it's an example of the power that is in Google's shares and why Alphabet would trade higher than General Mills. Price is a fact of the market. We've gone over a few ways to understand what a company's price is and to put it in context. Our next step is to put it all together: our understanding of the company's business model, our understanding of its financials and how it's doing, and our understanding of the current price to make an argument for what the value might be and whether or not the company is worth buying via its stock. Stay tuned for that. I'll cover that next time in a video that will be out next Monday. Subscribe to this channel to get that when it comes out. Check out shortinvestingguide.com for more information, examples, details, a chance to review all of this. And thank you for watching. I hope you enjoyed it, and I hope to see you next time.